Remember this, the balanced portfolio between stocks and bonds, and the usual advice was always like a 60-40 split between stocks and bonds. And bonds have always been viewed as a critical component of an income investor's portfolio because, after all, bonds are known as fixed income. But as of recently, due to just the market conditions we find ourselves in, bonds are no longer a good investment in my view. Now, it's not to say they have no advantages. In fact, the whole point of this video is to go over the role of bonds in a modern portfolio. So we're going to see the current state of the bond market, along with alternatives that I think have changed the game when it comes to safety and earning a yield in the market today. So let's come over here to the blackboard because I'm all about visuals. So what exactly are bonds good for today? We have the categories of returns, safety, income, and savings. In fact, if we look at this Investopedia article, which is labeled Some Advantages of Bonds, one of their major advantages is that it's better than a bank account. And this is where I think bonds shine. If we look at the best high-yielding savings accounts in October 2021, the API of a high-yield savings account right now is about 0.5%. And to represent the bond market, we're going to be looking at BND, which is the Vanguard Total Bond Market ETF. And right now, this has a yield of just over 2%. So in terms of yield, the bond market right now is significantly better than a savings account, but the other portion of whether or not it makes for a good savings account is the stability. So these are the returns of BND over the past 5 years. And to put this into context, let's throw up the market. So I think this view puts it into perspective. The bond market does fluctuate, but in comparison to equities, it's almost nothing. In fact, let's zoom into 3 years so we can get a better view of the most recent crash. And yeah, there's a small fluctuation, but overall, if you need your money at any given time, it's a lot more likely to be there with bonds versus equities. So to me, when you combine this stability with a decent yield, it does make for a good savings account. So what are bonds good for? I think a savings account is definitely one of the areas that they shine in. Unfortunately, this is one of the only areas where I see bonds as being useful in this market. And let me explain by going to the next one. So the next one here is income. Are bonds good for income? Once again, they're known as fixed income assets, so you would think that this would be another positive of bonds. So this is a graph of the 10-year treasury, which is used as a benchmark, and the yield is currently 1.6% to lock up your money for 10 years in a treasury note. We're looking at the all-time, so it goes back all the way to the 80s, so keep that in mind. But even so, there has been a clear trend here of a decline in yields over time. And currently, we're essentially at an all-time low. I mean, even back in the year 2000, the yield was 5%. And right now it's 1.6%. And this is what people reference when they talk about how we live in a low yield environment. 1.6% isn't anywhere close to keeping up with inflation. In fact, when you look at the trends of the yield, which is declining, and inflation, which is going up, this puts bonds and fixed incomes in an even more shaky situation. Something else to consider is to keep up with inflation, you need to have growing payments every single year. Inflation is usually not 5%, the average is like 2 to 3%. So each year, to maintain your buying power, your payments need to increase by 2 to 3%. And looking at the dividend history of BND, the physical dividend payment amounts have been decreasing lately, so the exact opposite of what you need to be competitive with inflation. And something else you have to consider is that this is a competitive market, so you have other options that you have to benchmark against. And one of the most attractive options right now is a dividend growth investing strategy like what's found in SCHD. Here, the dividend yield is a bit higher at close to 3%, and perhaps more importantly, the payouts are actually growing at a double-digit pace right now every single year. And visually, this is what that looks like. So as time goes on, your payments are becoming larger and larger. And this is how you can maintain your buying power in inflation. So I have to say, if you're looking for income, bonds are not your best choice. And that brings us to safety. And as we previously mentioned, bonds are way more stable than equities. And that's why they make for a very good replacement to a savings account. But when it comes to an investment, there's a very high price for safety. So looking at BND versus SCHD, that dividend growth ETF, yes, it is way more stable during sharp market declines, but this is the price you pay, a huge gap in returns. So, if we're looking at bonds through the lens of investing and being part of your portfolio, that's a very high price to pay for safety. But to finish off the safety category, we have to see what other options you have in the market. So, ETFs like SWAN exist, and the goal of it is to protect your capital while giving you some exposure to capital appreciation, which is the whole point of investing. The index's investment strategy seeks uncapped exposure to the S&P 500 while buffering against the possibility of significant losses. Approximately 90% of the Black Swan ETF will be invested in US Treasury securities. These, of course, are bonds. More specifically, they're the 10-year Treasury note, so that gives you a lot of the stability you might desire, while approximately 10% will be invested in SPY leap options in the form of in-the-money calls. And a quick little one-on-one on what leap options are. So leap is short for long-term equity anticipation security. A leap is an option strategy that is used when you believe in a stock's growth in the long term. And by long term, it's usually around 1 to 2 years. And that makes these options way more safe than a short term, 1 week out call option on, say, AMC. And just like all options, each contract controls 100 shares of the underlying stock or index. So it gives you leverage. And again, all you're betting is that the S&P 500, the 500 largest companies in the US, will rise over long periods of time. So this ETF combines that with mostly US Treasury securities in order to give you stability and some capital appreciation. And if we look at them side by side, they have very similar price movements, but SWAN does offer a bit more capital appreciation. In fact, actually a lot more price appreciation. In the past 3 years, SWAN is up 45% and the bond market is up only 18%. So that is significant outperformance with only a marginal amount of additional volatility. And again, just for perspective, we can add in the general market just to see how much more volatile the market is versus these risk reduction strategies. So that's why if you're looking for safety, I don't think bonds are even a good choice for that in the context of an investment portfolio. Again, if you want to use bonds as an enhanced savings account, they could work out very well for that. But the existence of these very unique risk-adverse funds like SWAN kind of make traditional bonds not really worth it. Another example that's very popular is NUSI. This takes a completely different approach, but ultimately it accomplishes the same thing. The strategy at play here is an options collar strategy, which limits your upper and lower potentials within a given time period. And they accomplish that using both call and put options to keep you within this narrow range of return. Looking at NUSI against BND, of course it's going to have more volatility, but that also gives you more upside potential. And benchmarking that against the S&P 500, this strategy of NUSI is significantly better than a traditional equity position. But the point here is that if you're a risk-adverse investor, you have lots of options aside from just bonds, and most of them overall are a better package. So if NUSI is still too volatile, even though it's better than the market, you can go with an ETF like SWAN, which is going to be a nice improvement over BND in terms of return, while not being much more volatile at all. Another super unique fund that just came out like 2 months ago that I'm going to make a video on is XCLR. This is similar to NUSI, but it's from the same company as QYLD, and this implements an option collar strategy on the S&P 500. And just quickly looking into this fund, this allows you to participate in the growth of the S&P 500 up to 10% on a 3-month time frame. By employing a collar strategy, XCLR aims to lessen drawdowns to approximately 5%. So this option-based strategy also has its advantages. So it allows you within a 3-month time period to have price appreciation up to 10%, while in that same time frame limiting potential losses to a maximum of approximately just 5%. Okay, so due to the existence of all of these very unique financial products that offer a wide variety of services, it makes the case for holding traditional bonds a very niche segment in this current market condition. I do want to mention that things could change. Maybe in 5-10 years' time, the yield of bonds will actually go back up, and that will completely change the equation. It's just that right now, they're not the best source of income you have. And in terms of safety, there's other financial products on the market that are just as safe as bonds, like SWAN, which is mostly made up of bonds, but they give you extra exposure to potential upside in the market. So that's why I think right now bonds are currently best served as an extension of a savings account because they are very stable and they do generate a higher yield than a traditional savings account. So coming back to this, I don't think the traditional advice of a 60-40 split is really applicable anymore to the average investor. There's simply too much opportunity cost, and you have other alternatives in the market like SWAN. But maybe someday in the future, if yields go up a lot and equities kind of cool down, maybe the 60-40 split will come back into relevance. But let me know what you think in the comments down below. If you're still watching and enjoyed, give the video a like, subscribe to the channel, all that YouTube stuff, and I'll see you in the next one.